Anybody have any questions before we get started? It'll take me another minute to get this thing up and ready. I think I put up another article or two over the weekend, I don't really remember. Also, under the video links in the course, you can link to Braden's YouTube channel, basically, and there you'll find these. But you can also, again, under YouTube, to the chapter number, and if you're in that link, and then the course information, which he's put up here on the board. So he's been recording the last couple of chapters. I think you're going to do this for the rest of the class?
Yeah.
So if that's helpful to you, the frame basically includes the slides, so you can kind of follow along and listen to the lecture and watch me scratch my ear and whatever several times as I want to do or whatever. So feel free to take advantage of that. It's very kind of you to make that available to everybody. I thank you for that. So hopefully that can help people prepare it. And it's up to Braden, obviously, how long he leaves it up there or whatever, even after the class or whatever. All right, so tonight we're going to cover chapter 10. And the whole idea here is talking about liens. We started, or lightly addressed this in chapter 7 when we talked about different forms of encumbrances, liens being one of those. And this chapter kind of gives away the premise. Real estate taxes and other liens, meaning, of course, that real estate taxes themselves are, in fact, a lien. That's really how you should think about them for the purposes of this class, is that the real estate tax isn't just the dollars, though we'll go over that as well. It's also the lien, the encumbrance of the burden against the property that they represent, and then what's important is the priority that we're going to start talking about. So this is just a definition of what a lien is, straight out of the chapter. And of course, again, as I mentioned, it kind of comes from chapter 7. So we talk about other encumbrances, such as easements of various sorts. There we talked about the police powers of the state. So again, an encumbrance is just kind of any burden of the property. A lien is typically there to enforce some kind of financial obligation. So there's a lot of different lien types and lien classifications. And I'll try and sort of in very rudimentary fashion give you the basics so you can understand what we're talking about and how this impacts us as real estate agents or investors. So a lien, being that kind of financial encumbrance, can be formed in a number of different ways. And every lien is either voluntary or involuntary. So voluntary is something you agree to, you negotiate, like a mortgage lien, for example. You sit with the lender, you want to borrow the money, and they want to have the way to take away the property if you don't pay. That's a voluntary lien, that kind of scenario. Involuntary are those things that exist as an act of law. So, such as a real estate tax lien. Nobody volunteers to pay real estate taxes. It's statutory. It's an obligation of the law, so therefore it's an involuntary lien. Some cases, these liens can also be, involuntary liens can also be equitable. So, you have money damages and you have equitable remedies under the law. An equitable remedy or equity deals with something that's more of an order rather than money necessarily. So in the case of an equitable lien, it was created by a court to satisfy a judgment, hence that concept. It's still involuntary. You ran up your credit cards too high, somebody goes to court, gets a judgment, it gets placed against your investment property or whatever. That's an equitable lien. Again, it's involuntary. So those are the few different examples that you'll see there. Again, but every lien, it's important to note, every lien is either voluntary or involuntary. Every lien is also either general or specific. A general lien is like the judgments that I just talked about that it affects all your property. So when a creditor does go out and get a judgment against the debtor, In Illinois, you're going to go and you're going to file that at the circuit court, which is located in each county, the state court system. And that judge will then be able to create this judgment, which then can be applied to all property that's known in that county. One of the things that's important to understand about real estate is that if you're sued in Kane County and your property's in DuPage, the judge or the court may or may not know about that other property. And your creditors may have to sue you in various counties if you own property in various counties. I'm not an expert in that area, but that's something, at least in the past, that has been a challenge. Chase that down because every county has its own separate records and has its own separate circuit court. Specific liens are those that are running to a specific piece of property. Again, a real estate tax lien, a mortgage lien. So in the case of, say, real estate taxes, if you own 12 houses, one in 12 different counties in northeastern Illinois, and you fail to pay the taxes on 11 of them, and there are 11 liens, the 12th property is safe from tax lien. It just does not, the tax collectors don't have the ability to lien properties other than that one to which the tax obligation is due. Same thing is true with your mortgage lender, unless they go out and get some other kind of a judgment. In general, the mortgage loan itself, that particular lien, runs only to that property. Now, it's different if you say cross-collateralize. You say, well, I want to borrow more money on my business, so I'm also going to put up my house. That's a different matter. Typically, under the normal scenario, mortgage lien runs just to that property. You're only encumbering the particular property that you're collateralizing or that you're putting up as security. All right, so again, every lien is either voluntary or involuntary, and it's either general or it's specific. So you can look at something like a mortgage lien and recognize it now as, oh, that's a voluntary specific lien. I entered into it voluntarily, the law didn't force me into it, and I agreed to it willingly because that's what I needed to do to get the money. I can look at my real estate tax lien as being involuntary and specific. Right, that's the kind of thing you could get test questions on some of these major liens and understanding, well, what, which are they? In practice, for you as a real estate broker, that probably doesn't really matter. But again, the state's always looking for ways for you to prove that you have a basic idea of how property can be encumbered, because it makes it more difficult for someone to sell property if, in fact, there are liens, there's other work that has to be done to get those cleared or something. I think we've gone over all that already, right? Yeah, okay. Oh, and by the way, I think there was a duplicated slide for those of you who downloaded these for notes. So at one point, if there's a slide missing, it's because I think there was a duplicate and I removed it. Hopefully I removed a duplicate, not one I need. All right, so lien priority. This may be the single most important aspect of talking about liens because of this idea of first in time or first in right, first come, first served, however you want to look at it, right? Liens are dated and time-stamped in at least to the minute. And it's an all or nothing kind of affair, right? The book sort of lays this out on a pretty straightforward basis. So if you are the first mortgage lender, you're not called the first mortgage lender because your loan is larger. It's called the first mortgage because it's in first place. It has the first priority position over all of the mortgage loans. It is possible and not completely unheard of for the first mortgage to be smaller in amounts than a second or even third mortgage loan on the property. It's all about priority. When lenders put up money, they want to know what's the likelihood we're going to collect. It's a what-if game for the lender or any other lien holder. Right? So one of the ways in which the credit is secured is through the ability to place a lien or the automatic placement of a lien on the property so that the lender can go through the process of foreclosure. Any lien can be foreclosed upon, regardless of who put the lien on the property. If it's a legal lien that would be upheld, whether it's a mortgage lien or a mechanics lien or a tax lien, any one of these can be foreclosed, which means that that particular lien holder, the owner of that lien right, can take the property through a foreclosure action or in the case of tax liens, through the tax sale, that sort of thing. Right? So again, it's really important to understand that process. Now, as we're looking at this example that they have in the book where they're talking about first mortgage lender, second mortgage lender, etc. It's also important to understand the terminology of a senior and junior lien. I don't know if they use this terminology exactly in the book, but again, it's what's used in the industry, and it's important to understand. If a senior lien holder is the one that's foreclosing, so let's use our example of a first mortgage and a second mortgage, and say there's $200,000 in debt on the property, and the first mortgage loan is, your first mortgage lender is owed 180, and the second mortgage lender is owed 20, something like that. If $180,000 is all that's obtained at the foreclosure sale, where does that $180,000 go? Just goes to pay off the first mortgage. But if there's $181,000, where does that second $1,000 go? To the second, and it goes there until the second is completely satisfied. All right, so it is an all or nothing kind of situation, hence the importance of really understanding what position you're in. So I like to describe that junior liens drop off in the case of a foreclosure action. So when that first mortgage lender forecloses, they have to go through proper steps and procedures to notify the junior lien holders to join them in the suit so they're aware of it. But when they purchase that property at the foreclosure sale, basically, when they take title to the property, all liens that were junior to that foreclosing lien are gone from the property. So the property is no longer encumbered by them. That does not mean that the borrower does not owe the money. The delinquent borrower still owes the money to all of those parties they owed money to. They're just not able to seize the property any longer to collect on the debt. So the second mortgage lender, for example, who would be out and have nothing, might be able to seek what we'll talk about in Chapter 15 as a deficiency judgment, but they have to go after the borrower personally, and through a separate collection action, the property is no longer available to them as a remedy. Right?
Even if the senior creditors are all satisfied with the payment, say they foreclose the house, even if all the senior creditors are satisfied, then the junior still doesn't get any of the cash.
Well, the junior will get whatever comes to them in order. So if you're talking about a junior mortgage, they will always still come ahead of the homestead estate. But if you're talking about a junior debtor or a junior lien holder who was originally an unsecured creditor, then in a foreclosure action, they're not only going to come after the secured creditors, meaning the mortgage holders, but they're also going to come after the homestead estate gets satisfied. So here's the fallacy about a junior lien holder seeking title. So what ends up happening in a foreclosure sale, basically it's an open outcry auction. Anybody here been to a foreclosure sale? It's an interesting thing to attend if you haven't. Kind of sort of wraps this up. It's very simple, really. There's not a whole lot that goes on there. But if you'll go, say in Kane County, for example, you'll go to the Kane County Circuit Court building in Geneva. And you'll go there and you will, there's a docket published. We'll look at the website later. It's just, I think it's canesheriff.com, canesheriff.org, can't remember. But anyway, there's a docket of what the foreclosure suits are that are up for sale for that particular day. Do all your due diligence ahead of time. You put up money. You have to deposit. I think it's 10% of the purchase amount, and you have to come up with the balance of the purchase price within 24 hours. So you have to be a cash buyer in effect. So you put up this deposit. You go to the auction. You put up the deposit, and you bid on the property. Now the lender, typically, though not always, will bid the exact amount of their indebtedness, whatever that is. So if the lender's owed $180,000, senior lender, the first mortgage holder, and they're foreclosing, they'll bid $180,000. They're not really going to pay themselves anything, right? They've already laid out the money. All they're going to do basically is a bookkeeping function, and the court and the law allows this, where they, in effect, kind of take money out of this pocket and put it over here in this pocket, and they convert their lien, their security interest, into title. That's what the foreclosure sale does for them. Now, if someone else comes along and thinks there's equity in that house because there's money to be made beyond the indebtedness to the mortgage holders, then that private party can bid beyond what the lender bids. So the lender bid, the first mortgage lender, let's say that all there is 180. That's the only debt, and they bid their 180. It's not at all uncommon for an investor to say dollar over, or even today just dollar, and the sheriff's representatives handling the sale understand that means that they're bidding $1 more than the indebtedness, and that's where the bidding starts. If nobody else bids, then that's it. The mortgage holder gets their 180 grand,
and there's $1 that goes to whomever's next, including if it's the delinquent borrower. That dollar would go back to them. Now, there are court costs and other things that have to be paid, but that's how the whole process works. So, and again, we'll look at this more in chapter 15 for those of you who are interested in foreclosure sales and short sales and this kind of thing, because it's kind of a normal part of today's market. So we'll spend a half an hour on it later in the course. But if there's a second or junior lien holder in that process, that dollar would go to them. And if there's a second mortgage holder, they would just get the $1. And if somebody bought that property, the investor buys it, at $180,001, if there is a second mortgage, they would be taking the property subject to that junior lien. The senior lien would have been satisfied, but the junior lien would not necessarily have been, and so they might be taking it subject to that if they're not careful. They have to make sure that that's all taken care of. Normally, all those junior liens drop off. One of the things we'll look at in a couple of chapters, we'll look at, I shouldn't say the junior lien. Sometimes people make, let me back that up. Sometimes people make the mistake of thinking that who's foreclosing is the first mortgage when in fact it's the second. I guess that's really the point I was trying to make. So if you have a case where the lender that's foreclosing isn't the one that is going to own the property free and clear, if you bid dollar over, you'll take the property subject to any remaining senior liens. That includes the tax lien and any remaining higher level liens. So again, that's what you really have to check out. So to say in a few chapters we're going to talk about title insurance. You don't get title insurance at a foreclosure sale. You have to do your own due diligence, your own research, make sure you know what the lien priorities are, and take that risk, or hire a title company and pay for an abstract and get that information. So again, it's a risky proposition to buy at a foreclosure sale. But again, just to re-clarify before I made some confusing statements, the senior lien holders, all senior remain, all junior liens drop off in the case of a foreclosure action. All right, again, date of recording, even down to the minute of recording, makes a difference. Again, this first come, first serve is a big deal. I was involved in an investment deal a number of years ago where 4 of us as individuals put up some significant cash against a particular piece of property. Instead of forming one entity where we each owned a quarter of it, we each put up our own equal amounts of money. And then it was my responsibility to go and record that information against the interest in the property. Once everybody had signed all their loan agreements and knew what their interest rate was going to be and what the risk was and all that kind of thing, as I was making my way to have this stuff recorded, I realized I had a big problem. I had 4 different parties, all of which who put up the same amount of money. Which one's paperwork was I going to hand to the county recorder first? Because all of a sudden, we're going to have priority 1, 2, 3, 4, and we had never talked about it. So I stopped in my tracks. I went back. No, I don't even know I went to the house. I did. I went to the house, wrote a note, got some other paperwork I think offline, put it all in an envelope, and mailed it. So it will be a completely random exercise. I was not going to tell my wife, hey, honey, guess what? I took first priority or last priority, or picked my, it was a really awkward situation. So again, it matters. You need to know kind of where you're going to be as a lien holder and where things are as an investor. And it matters for you as a broker. If you're going to work short sales, you've got to understand how this process works if you're going to help your seller get out from underneath that kind of messy situation. A subordination agreement is an agreement typically between lenders, but between any lien holders, that alters the priority. So let's say, for example, that you have a first mortgage and you're going to refinance it. And you have a home equity line of credit against which you have no debt, but you really like this home equity line of credit and you don't intend to change that at all. Well, if that home equity line of credit, indebted or not at the moment, if you refinance your first mortgage, it's going to become the second mortgage because your home equity line of credit lien would be dated whenever that was taken out. So it's not at all uncommon, instead of closing that line of credit, getting a lien release, and then reopening it after you've refinanced and getting a new lien placed against the property, to just have the new first mortgage lender and your old home equity line lender just sign a subordination agreement, which also gets put into the public record. So anybody who's looking at the documents can see, even though this loan came second, this subordination agreement makes it the first priority. So it is possible for any lien holder to change order for whatever reason they would deem appropriate again, with lenders, they typically make this determination when they make the loans. First mortgage priority will have a lower interest rate because it has a lower amount of risk, because you've got greater chance of getting paid back and less likely that somebody else is going to foreclose on your position. Any questions about any of that? All right, so let's move away from liens in general for a minute, and let's talk about taxes. Now, this might be a little bit confusing, this idea of a general tax. General tax is different than a general lien. So they're just talking about real estate taxes that are used for general purposes, to fund city, county, library, school, governments, etc. Not for some specific purpose like to replace a water main. That would be a special assessment. So general tax is still a specific lien. And it's all done ad valorem, or according to value. So it matters what the value of your real estate is, especially in a state like Illinois, where we're very property tax heavy for a lot of our undertakings. Where does 70% of our property tax revenue go? Local schools. Elementary through high school. Or today it's really pre-K through 12. So a lot of districts have early childhood programs. I know East and West Aurora both have significant early childhood programs as well. So yeah, that's important to recognize that creates a certain disparity also in our society. That if you could afford to live in Wilmette or Winnetka or whatever, you get whatever the numbers are, $10,000, $15,000, $20,000 a child to educate your kids. You live in East Aurora and you get 4 or 5. There is current legislation that's been proposed on and off over the last few years in Illinois to remedy that, but you can bet that the people who live in the wealthier districts fight that, because they don't want their money to go, people in Winnetka don't want money to go to Aurora or to Elgin or somewhere else. They want it to stay in their own communities. The state of Illinois, in theory, by Constitution, is obligated to educate the school children of the state, and they fail year in and year out because they allow this disparity to continue that really shouldn't be there. The state doesn't have enough money, and now with the recent tax cut, we have less money than we had last year. All right, so everybody pays taxes except. So what kinds of properties are exempt, or what kinds of property owners are exempt from real estate taxes? It's all in the book, and it makes common sense. Right up here, right? Cities, counties, state governments. What other kinds of organizations, more specifically, don't pay property taxes?
Churches.
Yeah, so long as it's a nonprofit organization. So I represented a church that actually was not a charitable organization. It was kind of a loose affiliation of the elders of the church, basically. And when they purchased the property, which they purchased from a prior church, they had to file papers with the IRS first. So in order to get a tax exemption with the county, the first thing the county looks at is, are you a charitable organization according to the Internal Revenue Service? If you are not, you will not get a tax exemption regardless of your purpose. So if you ever work with an organization like that, it's worth asking. I don't know if they ever got a tax exemption, but they did not have one when they purchased. They started working on it before, but how long it was going to take them to get it, I don't know. When they were a renter, it didn't matter to them. When they were going to be an owner, they realized, hey, this could cost us $10,000 to $15,000 a year if we don't get this tax exempt certificate. Their parishioners, 60, 80, 100 of them, however many, they didn't care. But the church elders realized they needed to do it once they were going to be property owners. All right, so besides churches, what other kinds of organizations? The one mentioned here, hospitals. Is that automatic for hospitals to be their properties to be tax exempt? Anybody know?
It'd be the same as the church, right?
Sort of. You have to be nonprofit, but there's also something more to it than that. A few years ago, when Blago the Weird was our emperor, he yanked the tax exempt status for Mercy Provena. And the presumption today is he did it because they wouldn't do something, maybe like contribute to his campaign. The next day, of course, they had a gaggle of attorneys working on it. So how does the governor or the legislature or anybody in power legally yank a hospital's property tax exemption? What is it that they're not doing? What are they obligated to do? Yeah, they're obligated to take a certain number of cases from people who can't otherwise afford the care. And if they don't do an adequate amount of that, then they are subject to losing that. Imagine at Mercy Provena what that property tax exemption is worth. 200,000, 500,000? I have no idea. A year? I mean, it's a lot of money. Could easily be $500,000 a year, maybe more. So yeah, that's a big deal. So again, it comes down to IRS regulations, it comes down to county review, and it comes down, in a case like a hospital, of are you providing the proper service. So again, it depends upon who you're representing or what business they're in or whatever as to how the laws or rules get applied. And institutions, most schools of all sorts really are a government agency, are tax exempt. Even a lot of private schools are set up as nonprofits. You can have nonprofit organizations that still pay property taxes. Very common. A lot of affordable housing complexes, for example, are set up as nonprofit entities. They don't have an owner. There will never be enough money to generate a profit. But they still pay property taxes because there's kind of an income motive to the property's very existence. So that's a fairly common scenario. And it's one of the reasons why we still can't have affordable housing in Illinois, because property taxes are high, and those apartment complexes still have to pay their share of property taxes to fund mostly schools. So again, even though you have public schools are going to be tax exempt, private schools or even some kind of private nonprofit sort of apartment complexes may also not be tax exempt.
Do you know if IMSA is a private or public?
IMSA is state.
State?
It's a state-funded entity, so it would be
Exempt?
yeah, it would be exempt. All right, other exemptions that exist. Oh, and I just want to mention, I think there's a very narrow deadline. If you work with a nonprofit, if there's a very short deadline, I think it's you can apply for the exemption before they take title to the property, but only like 90 days, and only if they have a signed contract. The county won't look at a hypothetical review, and they have 60 to 90 days tops. It's only like 60 days afterwards. So when a nonprofit is buying property, they need to apply for that tax exemption really quickly, because if they don't, they'll lose it for at least for the first year. In which case, that they have to pay for the entire year. Other thing I was going to mention is if you're a private property owner and you lease a property to 100% tax exempt organizations, what do you think? Taxable or non-taxable? Assuming every tenant in your building is, say, a government agency.
Could you repeat the question?
Yep, the question is, let's assume that every single tenant in your building is a government agency, or any obviously tax exempt nonprofit or government entity, so that there's not one for-profit or not one normally taxable entity in your building. Is your property taxed or not taxed?
I would say tax, because
Yeah.
you're there to make money.
That's exactly right. The Illinois Supreme Court, there's a case, I can't remember what the case is exactly, but I have to look it up from time to time. There's a case that specifically says if there's a profit motive on the part of the owner, that breaks the tax exempt status. So the same thing is true. Let's say Catholic Charities buys a 100,000 square foot office building and warehouse, but they only need 30% of it now, and 70% of it is rented out. That income stream might cause them to have to pay property taxes until they get up to where they are using more of it for their own charitable purposes. And the county looks at all this stuff, and they don't take the exemptions lightly. All right, so other exemptions that exist. These are much more likely for you to meet in practice and much more likely for you to be tested on along the way. And it's all a matter of public record. You can find this in the multiple listing service. You can find this on the county treasurer's website. You can find it at the township assessor's website. Property tax information is readily available to you online at any moment, an hour of the day. So, and we'll look at this a little bit later when we look at how the taxes are calculated. Look at how this applies exactly. But in Cook County, the dollar amount is $7,000. Everywhere else, it's $6,000. If you occupy, if you're a homeowner occupant of a residential property, then you get a $6,000 tax exemption. Same house, you move out of it and rent it to somebody, or you just move out of it and nobody moves in it, you lose that tax exemption. You have to be in the house on January 1st, and then it applies for that year. If you literally buy a house and close on it on January 2nd, you probably are not, but legally you're not entitled to that tax exemption for that entire year, but then you would be for the year afterward, unless somebody else lived in it on the first. I say that because I purchased a house from an estate. The last surviving member of the family, she died in October. We occupied it right after the first of the year, and we had no tax exemption for that entire year because it wasn't occupied on January 1st. Anyway, Cook County offers a bunch of different options. I wouldn't worry about those Cook County specifics unless you own property or live or will or plan to live in Cook County. So if you're a senior citizen, 65 years of age or over, occupying your principal residence, you not only get the homeowner occupant, the homestead exemption, but you also get a senior citizen's exemption of $5,000. So those two go together. Now this can matter if you are representing somebody who is purchasing a property. Let's say they're going to purchase it to rent it out, and they're purchasing it from seniors who are occupying it. You can see a significant bump in the property taxes simply by the removal of those two exemptions when they take title, or the year after they take title, since it takes a while for this to cycle. So again, you want to pay attention to this. Even just a person who's going to lose the homestead exemption is going to have a higher payment on their taxes than maybe they planned for. And if your buyers are tight on their qualification financially, that could matter to them in that second year when their taxes go up, whatever, $100 a month or something like that. It could make it a little more challenging for them to be able to make that house payment. Again, all of this is public record, you can see it. And if you have a house that somebody's looking to purchase where it's vacant currently, it's possible that their taxes will go down in the first year or two because they'll be able to get an owner-occupant exemption. You should, again, help encourage them to make them aware of that. They'll be paying a little bit more initially, but in the following year, if they file the proper paperwork, that should be taken care of. There's a bunch of other tax exemptions or concessions in here that I'll mention just so that you're aware of them. All of this can be found online. A lot of it is not in the book, at least not in this kind of detail, but again, just in case you run across this. So for seniors, there are a couple of options for how they can hold their taxes down besides the homeowner occupant exemption we just talked about. Not everybody gets to the retirement age and then sells their house and buys a condo in Boca Raton. For a lot of people, their children, their grandchildren, their life, everything is right around where they are. So they want to stay in that same place, literally oftentimes that exact same house. But once you're on a fixed income, and you either can't work to make up for it or you don't want to or whatever the case may be, what it costs you to stay in that house becomes critical. And for some people who live in places like Hinsdale or Glen Ellen or Wheaton, Naperville, where you've lived in the same house for 40 years and so you've paid it off and now all you really have to pay are taxes and a little bit of maintenance. The good news is you live in the middle of an economically robust community where property values are going up year after year until your net worth is increasing, and woo-hoo. The bad news is your income isn't going up as fast as those home values are appreciating or the tax bill's going up, and it gets harder and harder and harder every year for you on that fixed income to cover just the property taxes. So the way you can deal with that are one of these two options. One is to get an assessment freeze. So long as the household income is $55,000 or below, again, everybody has to be 65 or, the owners have to be 65 or above, but so long as the total household income is $55,000 or above, you can freeze the equalized assessed value of the property. So the assessed value that we use for determining taxes can be frozen. So then from the time you're 65 until the time you're 98, the assessed value stays where it is. You're still subject to increase in tax rates, but not the double whammy of increase in tax rates and the increase in value. So it kind of cut those increases in half. Yes, sir?
Okay, so this refers just to the property that you're living in.
Correct.
So it doesn't count if you have other properties, other places.
Correct. Yeah, investment property, whatever, doesn't matter. And so let's, looking at this scenario here, there's also some other limits. This total household income limit does not mean the owners. So let's say, for example, at some point in time, we've got Grandpa who's living in the house by himself, and he makes, $38,000 a year on his fixed income, and that's what he's got, and that's everything. He would clearly qualify for this. But because maybe he needs some care or he needs some help or whatever, his loving granddaughter moves in with him. Problem is, she makes $20 grand a year. Now together they're over the limit, and he loses the freeze exemption. its total household income is not limited to the homeowner, it's whomever would live there. So if you do move into the parents' or grandparents' house, you can jeopardize this. You can still have home care, you can still stop there every day, you can probably stay there a time or two, but if that's your residence, then you've got to be factored into that income limit.
Does only one of the owners have to be 65?
I believe so, yes, because that makes them entitled to the limit, right? Because you can have one owner, so I think that's correct. Again, check this to make sure, but you can find this on any county website, probably most township assessors' websites. These are the kinds of things that there are a handful of people in each location, each county who know how this works. They're dying for people to call them because their whole job is to help people, right? And as real estate agents, you're not necessarily likely to run across this, but maybe as individuals you'll see this and it makes sense to look and see if it applies. And of course, you hope that this limit will go up annually. I'm not sure how often they adjust it. All right, then the deferral program is a little bit different, and I think it's a one or the other. You don't get both. I think it's an either or option here. And the deferral situation is that, again, 65 years of age, you have to pay the taxes eventually, but they're deferred entirely, or they're for some period of time, up to $5,000 maximum. It accrues interest at a 6% interest rate, and the debt gets repaid eventually. Once the taxpayer dies or moves out of the house, then the home has to be sold and the money's taken out of the estate, or for any other reason you no longer qualify. So again, it's the kind of thing that it's there, it's available as an option, something worth pointing out to people. How much of this do you have to be an expert at as a real estate agent? Probably very little, except to know that it's there. Again, you're the person that people are going to turn to for free advice. Hey, what do you know about the capital gains tax exemption? Hey, what do you know about the property tax exemptions? At a minimum, I would say, you know what, that's a great question. I know they exist. I'm not up on the most current rates and numbers. But if you check the county website, or if you contact the county treasurer's office, or if you go to the supervisor of assessments or the tax assessor for your township, somebody there can help you. You'll find people there who will be experts. And then it's out of your hands, but you've done your job to refer people to the right place. Homestead improvement exemption, again, you're occupying the property. This is where if you do some maintenance, or not maintenance, but do some major repairs, instead of just maintenance, maybe you put an addition on, something that would enhance the value of the property, the county government will freeze that increase up to $75,000 in assessed value of your home. It'll freeze that increase for up to 4 years. And I think the reason that they do this is it's their way to say to you, look, if you'll just tell us that you remodeled your basement, for example, you've now finished your basement and you've had $25,000 in value, don't hide it from us. Tell us and we'll freeze your taxes for 4 years. Keeping in mind that the township assessor has no right to enter your house to find out, in fact, that you've remodeled your basement. The only way they would know is if you had to pull permits and they made an estimate of value from the information you gave the city or the county in terms of pulling permits. But for some kind of remodeling or work, permits may not be necessary or may not be obtained, even if they were legally necessary. So again, it's a short-term, temporary thing. Put a bunch of money into your house, put a big addition on the back end, live in it 3 years, enjoy the lack of increased taxes, and then sell it and let the next fool figure out what happened. So if you are looking at a house that's way under taxed as a buyer's agent, you might want to inquire whether that kind of thing applies. It's all public record, but an inquiry is appropriate. Be very careful when you're looking at tax amounts. If you have a bunch of properties that are all assessed in the same range, and then there's a fourth, a fifth, a sixth one, whichever one it is, that's 20 to 30% below the others, that is not a gift from God for your buyer. That is some kind of information that's lacking in the system or that you're not aware of, because eventually that's going to catch up and your buyer is going to get hit for those higher taxes. So try and figure out why are these taxes so much less, so your buyer has an idea of what kind of risk they're taking. At least one of these Illinois veterans programs I think is just ending. I can't remember which one it is, so again, look at this. But people who are returning from service in Iraq, Afghanistan, or wherever else that qualifies, there are some other specific veterans exemptions that are meant to be more generous than some of the others. So it's the kind of thing, even I think these first two, one of the two of these can be done multiple times. If you go on service and you come back for at least a year and then you leave again, you're deployed again, it's the kind of thing that will come back while you're gone. But it's the kind of thing you have to, it's while you're gone or when you're returning, either way. Depends upon the particular program. So again, it's one or the other that you're going to end up taking. All right, so that's the basic idea.
What did the EAV stand for?
Equalized assessed value. We're going to look at that when we look at the various options of kind of how this is processed, etc. So I'm going to pass around a couple of tax bills. The first one is a few years old. It's on my house. If you have a survey showing not only where I live, but like what the shape of my house is, you might as well have my tax bill. I very frequently have students say to me how foolish I am to give out all this personal information. Let me tell you, this is all public record. This information is already given out. You're just too lazy to go find it. So now I'm making your life easier by giving you what you need to be able to egg my house on Halloween. And the second one that I'm going to hand out in a minute, I think I'm walking around here. That one is on a business property in Kane County. That's the office building that I own and manage here in town. So you'll be able to see what a couple of different tax bills look like. And these change from year to year, the format of things. So the colored one that I just handed out is a DuPage County bill from a few years ago, though, again, they look pretty much the same. So the assessment process is the process of determining what the property is worth. Where I live, in Milton Township in DuPage County, the assessed property value for tax purposes is something in excess of $4 billion. Which means for market value purposes, that real estate in that one township, that one 6 mile by 6 mile block, is at least $12 billion according to the valuation done by the township assessor. DuPage County has 9 townships. That makes an estimate of the property value across DuPage County to be something in the $100 billion range for market value purposes, and it's probably north of that, maybe significantly. So with those kinds of dollars, you can see that there's a lot of money to be generated for county governments and all of the various agencies that are contained with or funded through the property tax purposes. It's huge. The school districts are getting tens of millions of dollars a year. Right? And again, this is an important thing to understand. This is how we fund those things. If you took that away, you'd have to have much higher something else. Income tax, much higher sales tax. California, for example, a state that's known for very high taxes, has a much lower property tax rate than we do, much lower. But they have much higher income tax, and they have at least as high a sales tax as we have, probably a little bit higher. It's as high as what I'm used to paying in DuPage and Cook, where taxes are a little bit higher, but maybe a little bit more than what you pay in the downstate by 1% or so. So again, the money's got to come from somewhere. We just happen to choose property taxes, which, as I said, creates an unfortunate disparity because of the nature of the type of tax. Just my opinion on that matter. So when we talked about townships in Chapter 9, right, we talked about them as being a unit of local government, basically, is what they are. We talked about them being in geographic form, but basically, Illinois has the single highest number of local units of government of any state in the country. In part because every township is its own unit of local government. About half the governments in the state are townships. They don't do a whole lot because they're not like a town. A town or a city is a different entity than a township. So like there's the city of Aurora, but there's also Aurora Township. So one of the things that Aurora Township does is it has an assessor. And you vote for this guy or gal every 4 years. And it's one of those positions that when you go to vote, you look at it and you go, what is this? What do these people do? What's the township highway commissioner responsible for anyway? Well, he was responsible for all the highways that exist in the township that aren't otherwise in a municipality or designated as a county road or a state highway or an interstate. I think there's about 12 feet of that left, but whatever, that's what they're responsible for. The township assessor, that's a busy person. The township assessor really is an appraiser in effect, using mass appraisal techniques to value every single piece of property in the county. Tax exempt or not, every piece of property is being valued. And usually they're valued every 3 years. Township assessors will sometimes do what they call a triennial reassessment, where they'll go in 1 year they'll reassess the entire township. But more frequently what they'll do is they divide the township into thirds, so that every year they're reassessing a particular third of the township, so that every property's on this every 3-year cycle and they don't have these huge peaks and valleys. They look at what properties have sold for, they look at what's the occupancy rate in certain properties, that kind of thing. A lot of different information that they look at. So then they take the market value, the actual value that they believe a property would sell for in the open market. And then in Illinois, everywhere but Cook County, we won't worry about Cook County's rates, 1/3 of that market value is used as the assessed value. So we start off with market value, we really multiply it times 1/3, or 33 1/3%, and that result is the assessed value. Equalization is the process where somebody goes, you know what, we probably need a township-wide adjustment. It could happen by the township assessor, not likely. The county assessor, at the county level, they have a board of review where they can look at that, and the Illinois Department of Revenue can also look at that. So an equalization factor is a way not to adjust one property, but to adjust across the board in an entire township. Gee, this township assessor seems to have been awfully conservative this year, and we think he's too low. We're going to raise the entire township by 1%, 3%, 7%. Gee, look at these two townships side by side with subdivisions that cross over. This one township seems to be overly valued. We're going to reduce it by 3 or 2 or 1%, which I've never seen. I've definitely seen equalization factors where they raise the amount. So the cynic amongst us would say, that's what they do when they realize, crap, we don't have enough money for these government agencies, so let's throw a couple of equalization factors out there and raise the property valuation above what the assessor said so that we can generate enough tax revenue so that the school district doesn't have to cut the salary of their superintendent of schools or whatever. All right, so there's 3 different levels. Again, you're not going to get tested on this. Equalization factor, yes. Where it's applied, no, but you should know it can come from different places. So again, we start off with market value. We multiply that times whatever the proper assessment rate is. Then we multiply that result times any equalization factor that's there. An equalization factor below 1 would reduce the value. Above 1 would increase the value. Just wanted to see. Just wanted to see if there was an equalization factor. There might be. Let's see. If you look on the 2-page county bill, it says 0.9625. So I don't know if that's an equalization factor, because normally that state multiplier would be, I don't think that's what that is. See where on the right here where there's a state multiplier? That's oftentimes where you're going to see that increase in value. It'll be 1.0 something. The year before this, I think we had about a 7% bump in the equalized value. Values were falling, and the tax revenue was a problem, so they just bumped the values. Here, you've got that number, S of a factor, 0.9625, so I'm not quite sure how they've arrived at that or what that is exactly, because it equates out to the fair cash value, so I'm not sure what that was intended to mean. So you don't really see it there, but that's where it would be, where it would be shown. That equalized value or equalization factor would be on the bill there somewhere.
So,
Yeah.
I just want to make sure I follow this. When I look at your bill here, your assessed value is 15853, or Yeah, 158,530.
That's my assessed value, right. That should be 1/3 of the fair cash value of 475,600.
Okay, and now that you get the residential owner occupancy exemption.
Right.
You're gonna subtract $6,000 off of that number.
Correct.
Okay, and then you're gonna multiply it by the 6.1265, and that's what your tax bill is gonna be?
Yeah, and that's the percentage, that tax rate that's there.
Right,
Yep, that's exactly it. We're gonna get to that next.
okay.
So, but now you can see where the homestead exemption comes off. It doesn't come off of the market value, it comes off of the assessed value, which makes it seem a little larger. So here are the steps, and you will be given a math question on your final exam where we give you a property value and we give you some kind of an assessment rate, and we may or may not give you an equalized assessed, or excuse me, we may or may not give you an equalization rate, and we're going to give you some kind of tax rate, and you'll be asked for something like, what's the annual taxes due? Or what's the first installment due? Or how much money has to be set aside for mortgage payment, or, in taxes, something like that. So, again, know these steps. Market value times assessment rate, which we know in Illinois is typically 33 1/3% or 1/3. But I caution you that in these math questions, you will not be given that as an assessment rate. Probably never. It'll be 20% or 50% or some random number. If you're given the math, just run the numbers. Don't say, hey, wait a minute, professor, this can't be right because it's not 33 1/3%. Just plug in whatever number we give you, the market value times that assessment rate. That gives you the assessed value. That then is multiplied by the equalization factor, which in the case of these two tax bills, at least the state multiplier rate is 1. So you're just multiplying this times 1. If you're given an equalization factor, you need to multiply by it because it will either increase or decrease the value that's applied to the tax rate. And your equalized assessed value, this EAV that Ken was asking about, right? That's the assessed value after the application of whatever the equalization factors are. Okay? So once you take that equalized assessed value, you're going to subtract out the exemptions, which I will not do to you on your final. But you should know that that's where it would come out. That's where you would subtract the 6,000 or the 5,000 or whatever you would have. So when the less a property is worth, the more significant those homeowner and senior occupant exemptions are worth, right? Because those are fixed at 5,000 or 6,000. And if the house is only worth 100,000 market value, $33,333.33 from an assessed value, a 5,000 plus a 6,000 exemption wipes out 1/3 of the value. But if that house, the market value of that house is 300,000, assessed at 100, it barely wipes out 10% of the value. So again, see the difference of how those exemptions work. So that would get you the annual tax bill ultimately. Now, the tax rate itself can be given to you in a number of different ways. There are about 5 different ways in which those numbers can be given to you. We'll look at that in a minute. I think I have an example of that. But it can be given to you as a percentage, which it is here, or dollars per hundred, those two, which it is basically in this, on the tax bills. It can be given to you in dollars per thousand or mils. Those two are the same thing. It's kind of a confusing term. I will not use the term mils, but you could see it at the state exam. And it could be given to you in a decimal, which hopefully you can convert between decimals and fractions. If not, you should practice that. All right, so if you're asked something like, what's the first installment, you should recognize that our property tax bills are paid in 2 installments. Cook County, it's March 1st, and whenever they get the actual bill out, it's supposed to be March 1st and September 1st, but sometimes it's March and October, March and November, depends on how late the county is. Cook County is very frequently late. And in Cook County, the 2 installments are not equal, because they get the first bill out so early they don't know what the tax bill is. Everywhere else in the state, it's June 1st and September 1st. And the bills are equal. First half, second half, because they know what it is. And they have to give you 30 days notice. That's how Cook County gets themselves in trouble with the second bill being late. If you don't get at least 30 days notice from the mailing from the time that they mail it, then they have to push it back. So I think it was a couple years ago, my tax bill, instead of being due on June 1, was due on like June 4th. There was a weekend, plus they were late a day, or they thought they might be late a day getting it out. So they just pushed the bill back a couple of days. Otherwise, if they don't, somebody's going to file suit, and you'll be pushing the bill back even later, and those agencies need the cash. All right, so that's the basic idea, two installments. Lenders oftentimes require escrow accounts, impound accounts, reserve accounts. We'll talk about this again later. But lenders want to make sure that the taxes are paid. Why are lenders so concerned about the real estate taxes being paid?
Because the tax man gets his money first.
The most important thing to understand about all this lien priority and all this kind of stuff is that of what I call the king's position, or ladies, if you want, the queen's position. King comes first. King plays by his own rules. Lien doesn't have to be recorded. Doesn't have to be written down at all. You're supposed to know that it's there. And even if the lien is current, in other words, the taxes are paid, it still takes priority. So lenders, to make sure that they don't get closed out by the tax man, want to make sure that those taxes are paid, in which case they say, you pay us the money, we'll take the responsibility for paying it to the county. It also gives them free cash to use, because they don't typically pay any interest on an escrow account. Not all lenders do that. Some lenders don't, or won't hold the tax money. They don't want the responsibility or the liability. They want you to be responsible for paying the taxes. All right, as part of this overall process, let me see if I've got some. I don't have any numbers up here. Thought I did. All right. Yeah, let's just go ahead and take a look at this tax bill a little bit more then, using that for our math calculation before we move on. Make sure we've kind of are following the bouncing ball. All right, so again, on your final exam, you'll be given a market value, which on the tax bill is represented by the term fair cash value. Market value is better defined in Chapter 19, but what it is basically is the typical sale you would expect in an arm's length transaction between unrelated parties in a typical sale today, or whatever you're putting the value on the property. So that's the assessor, the township assessor's opinion of actual market value. That's the $475,600. They break it down between land and building, but we don't really care for our purposes here. That's just how they came up with it. So the assessed value is 1/3 of that $475,000, and it is a little bit less than that, because 1/3 of that would be that must be multiplied by that 0.9625 factor is an equalization factor that must be in there. Because 1/3 of that would be something larger than that, right?
Where are you seeing that equalization
Within
factor?
$10.
Is it within $10? Yes, maybe I guess it's not. Down here at the bottom of a factor 0.965. Under equal,
Oh, okay, I see
under
it
assessed value.
out of the grid.
But it doesn't, I've never seen it applied like that at any other time, so I don't know what maybe that's, actually the assessor did it himself, so maybe that's applied actually at the fair cash value level, that's why we're not seeing it. Anyway, I don't mean to confuse you with that, I just noticed that for the first time. I've used this for 3 years and never noticed it before. Paid the stinking bill and never noticed it before. All I paid attention to was what I owed. Anyway, so you take that fair cash value times whatever the assessment rate is, and you're going to get that assessed value. The state multiplier would be what I'm saying would be the equalization factor here. Again, on the tax bill, it's 1. You'll see something just a little above 1 or just a little bit below 1 for an equalization factor. You would multiply that times your assessed value, and that'll get you the equalized assessed value. I'm not going to give you an exemption like here, the residential exemption, the senior exemption. Those will all be 0 in my exercise. But you're going to take that equalized assessed value and multiply it times the tax rate. And again, it can come to you in a number of different ways. It will either be a percentage, like this could be 6.1265%, dollars per hundred, which could be $6.1265 per $100 of value. That's the same thing. If this were a decimal, it would be 0.061265. If they were to give you the tax rate in mils, it would read 61.265. A mil is 1,000th. Mils are used in machining and paint thickness. Really, it's not something we typically use in real estate, but taxes is the only place I've ever seen it. And you could see that at the state exam. I think mills were used on my appraisal licensing exam.
What was it again?
A mill, M-I-L-L, meaning 1/1000. So what happens is if you have here 6.1265, that's $6 per hundred. So it would be $61 per thousand. You literally just move the decimal over one place. You might have some math practice questions in the book using mills, I'm not sure. Out of 5 real estate licensing exams, I saw the term mill once. So I wouldn't be too freaked out about it, but you know that's what happened. It's per thousand instead of per hundred. So the way you would do that is if you're given this as 6.125 per hundred, you take and you divide the tax amount, the assessed value by 100, and then you multiply it times 6.1265, which is the same thing you get when you multiply by 6.1265 and then hit the percent key. The calculator does that for you automatically, right? Percent, por ciento, it's per 100. So anyway, any one of those 4 or 5 different ways is a possible way they could throw the value at you. I don't remember how I do it, but it'll be something more straightforward. Dollars per hundred, percentage, or decimal. It'll be one of those 3 ways. I guarantee you that. That's more normal. And then you'll be asked, what's the total tax due? What's the first installment? How much has to be set aside for the monthly mortgage payment? In which case you would either have the whole result, half the result, or 1/12 of the result, right? That would be the worst case you would get. So that's what the math will look like. There's a practice question on the quiz that I'll give you on Thursday, and like I said, there are probably several in the comprehensive math review online. So that's what the math looks like. All right, let's see. All right, just really fairly quickly, again, you could get tested on this at the state exam, I suppose. How does this all work? Every government agency has to come up with an annual budget. And they do this well in advance because they have deadlines they have to meet. They give that budgetary information to the county treasurer, and the county treasurer then sits and looks and says, okay, this is what every one of these government agencies needs. And every property has a slightly different, or can have a slightly different mix of who the taxing bodies are that property tax is helping to feed. So you take my house, right? Remember that it's in one township, and elsewhere in my same subdivision, if you remember from the legal description, is a different township. Townships have tax rates. Move townships, slightly different tax rate for the property. Get outside the village of Glen Ellen, it's still in my same township. You're no longer paying for Glen Ellen Police. You're now paying for the county sheriff. You're no longer paying for the Glen Ellen Library, though if you want to use the Glen Ellen Library, you'd have to buy a library card. I grew up in Lyle Township outside of the city of Naperville, and every year my parents had to write a check to the Naperville Library, to Nichols Library in Naperville, so that I could go and use the library. Because we weren't in the city, so we didn't pay the money. A lot of libraries are municipal specific. Aurora is probably the same way. If you're inside the city limits of Aurora, you pay money to the Aurora Library. If you're one property outside of the city of Aurora Library District, you don't. You can still use that library, but you have to pay them a fee to get a library card. So those agencies come up with those budgets, they forward them to the county treasurer, and the county treasurer looks at those budgets and looks at the property value for the entire county, but township by township, and then applies that and makes sure that there's going to be enough money so that they get what they want. There are limits on how much those rates can go up or down. Well, they can go down all they want, but they rarely do. But by statute now, the rates can only go up a certain amount, and the values can only go up a certain amount. It's a complicated and long, drawn-out process. Lots of different taxing districts. Let's just look at this tax bill, and you can look at all the different tax districts on this Glen Ellen property tax bill. You got DuPage County plus the pension fund, and that's different than the county health department and their pension fund, which is different than the Forest Preserve District and their pension fund, and the DuPage Airport Authority. One that really bothers me is the DuPage Water Commission. Those are the folks that are bringing the Lake Michigan water out to my house. What's their tax levy?
No.
Nothing. That entity has existed for 27 years and never gotten 1 penny of tax money. which makes me wonder how much money are they making off of pumping water from Chicago. Milton Township, again, there's that, and then Milton Township roads, Village of Glen Ellen, which I just got notice that the Village of Glen Ellen from 2014 to 2015 is not going to increase the tax levy at all. So I think for 10 years in a row, the Village of Glen Ellen's tax levy by percentage went down. Then they had to have an increase and then another nominal increase, and this year they're holding it flat. So I'm pretty happy with the Village of Glen Ellen. The thing is that it's a relatively small number when compared to, say, the school district. If you look at the really big numbers, right? It's the grade schools and the high school. Best deal here is the mosquito district. $12 and I don't have, West Nile, whatever. So if you take a piece of property and you change any one of these government agencies, you move that because that property is now in a different school district or not inside the city, then the tax rate changes. You can go to DuPage County, for example, and Kane's probably the same, and you can buy from them a book. It's about 3/8 to a half an inch thick, maybe 3/8 of an inch thick, full 8.5 by 11 size. And all it does is list every possible combination of taxing districts. So if you want to know what would the tax rate be on a given property in a given place in the county, you can look that up and see. Because it varies significantly. Even within DuPage County, residential property rates will go from 5 something up to over 9. So in a township like Joliet Township around West Chicago in DuPage County, the tax rate is a lot higher than most others. But their assessed values are also a lot lower than they might be. The combination comes out similar to how it would in other places. So once all that's figured out, then the tax bill goes out, and that's the whole idea of appropriation and making sure everybody's got enough money. You pay it as we talked about. You can find out what your property has been assessed at about 6 months in advance of your tax bill coming out. You'll get a notice of valuation well in advance of the actual tax bill. And that notice of valuation, by the way, is also your notice to appeal. Once you've got your tax bill, you are months too late to appeal your taxes. It's the valuation that you appeal, not the tax bill. Unless they have overstepped their taxing authority, you cannot appeal what your school district is taxing you, or what your municipality or library board or mosquito district is taxing you. You appeal the valuation. My neighbor's house is a twin house of mine. It's valued at $300,000. Mine's valued at $330,000. That stinks. I want mine reduced. If you use that kind of logic and do it in a timely way, you stand a chance. But if you don't do it on that basis, you valued this property at X and you valued mine at X plus 10%, you probably won't win that argument. You do not have to be a real estate agent or an appraiser or a lawyer to make a living or to do any representation of tax appeals. There's no licensure required at all. Most people do their own, but those who don't, again, you can pay somebody to do it for you, and that there's no licensure of that particular activity in Illinois. Very important, and also important to understand for test question purposes, are what happens, or what are the deadlines, or what happens if I pay late? So, well, yeah, right, we've got several possibilities. If you notice up here on the top of this bill, we've got our due dates of June 1 and September 1, which September can get delayed a little bit. If you have a Labor Day weekend, it can be a few days later. And they'll always be due on a Monday through Friday and not a holiday. So again, it's not at all uncommon to see as late as June 3rd and as late as September 4th without meaning there were tax delays or delivery delays on the bill. All right, so it says here underneath number 1, you've got all these dates, June 2nd through June 30th. It's got different amounts. And then underneath there it says no payment will be accepted after November 16th. So if I don't pay my first installment on June 1st, if I pay my installment on June 2nd, what has happened?
An increase.
Hmm?
An increase.
Right, but by exactly how much? You're going to want to know this. 1.5%. And it's per month or portion thereof. So notice, once I miss June 1st, it doesn't make any difference if I pay it on June 2nd or June 30. The penalty is the same. 1.5% per month or portion thereof, and it does not compound. It's the same penalty every month. It adds up, but it doesn't compound. You don't pay the 1.5% on the original bill plus the prior month's late fee. You just pay that 1.5% per month. All right, but then it says, so if I still haven't paid it by November 16th, then it says that it won't take any payments anymore at all. Why wouldn't they want my money after November 16th? If I win the lottery on the 17th and have the money to pay off the whole tax bill, why won't they take it? Yeah, it's because the tax sale comes next. So it's important to understand that the initial penalty is this 1.5% per month or portion thereof. But eventually, what's going to happen is at some point in time, the county is going to auction off a very important place. And that very important place is,
Your house.
no, it is not your house. It is the place of the king's position. They do not sell your property, they sell the government's tax lien right. So at the initial annual tax sale, that's what's for sale, is the king's position. First place over everything. It isn't a matter of saying, oh yeah, okay, now, Ken hasn't paid his taxes, so let's sell his house. That's a long drawn out process. Instead, it works a little bit more like this. In fact, why don't we go ahead and we'll take a break, and we'll come back at 8 o'clock or before that once everybody is here, and we'll pick up and we'll go on with this.